Hi, this is Victor from the Fifth Person, and welcome back to our part 3 of the video training series, where I'm going to share with you two past case studies using the investment quadrant formula. But before I move on, I'm going to run through the usual disclaimer, where whatever I share today is for educational purpose. It's not a recommendation to buy or sell. So let's move on. So back in 2010, I was screening the stock market using the criteria and the screener tool that I shared with you at our first training video. And that's where I came across this company called Japan Food Holding Limited. This company actually cleared my investment criteria, and I downloaded their annual report and decided to do a little more research about them using the investment quadrant formula. Okay, which is this I'm going to use to analyze the company. So if you have eaten in Singapore before, you should know them by their consumer brands such as Atchison Ramen, which is their largest and most successful brands. And they have other brands like Agite, Fruit Paradise, Japanese Gourmet Town, and many other brands that you can see on the slide right now. I did my on-ground research on Japan food by visiting their various F&B outlets in Singapore, and they are always packed with consumer. And later I decided to dive deeper into their financial numbers of Japan food. So let us move on. So if you look at Japan food, based on their sales generated, their largest segment in 2010 at the point of time where I look at them was actually Atchison, which accounts 61% of their total revenue, which is their main cash cow business. Followed by Poteju, which is 10%, Alba, which is 8%, Fruit Paradise at 4%, and the others accounts about 17% of their total revenue. Then I also went to dig out the industry margins of the different F&B outlets that are operating in Singapore. And I found that the restaurant margin in Singapore is about 5%, the fast food margin is about 6%, the food caterer margin is 19%, and the others is around 5%. So Japan food is a restaurant business. Hence, we should focus on the 5% industry margin that they should achieve. When I dig out Japan food margin, I found that Japan food margin is about 10%, while their competitor like Sake Sushi is at 4%, ABR is at 5%, which they use, ABR is the operator of Swenson at 5% margin, Soup Restaurant at 6% margin. So from this figure, I can see that Japan Food has superior margin and better cost management over their competitor. At the point of time when I was looking at Japan Food, I think that Japan Food can't really grow much, because the maximum outlet for one brand in Singapore to hit saturation point is between 20 to 25 outlets or maybe 30 outlets. And that point of time, Japan Food have about probably 17 outlets at that point of time. So we do not expect the number of their regional outlets to grow also, because they focus mainly on Singapore. So their regional outlets are very few only, I think probably 4. And we don't expect them to grow as much. So that was one of the things that set us back from Japan Food. But I'm going to talk more about later why we still choose to invest in them. Next is we also want to dig out all the possible risks that can hurt Japan Food. So the first risk is the poor geographical diversification. Okay, so they are mainly in Singapore, and the rest of their outlets overseas is just a few outlets only. So you can see that the majority of business is generated from the Singapore itself. And to operate F&B in Singapore, the location is always very important for all these F&B company, and it's very challenging to find good location. Next is this industry is highly competitive, and more F&B will enter in the industry in the future. And there's also a concern regarding the rising operating cost for F&B and the rental and staff cost, which is continue to rise. And next thing is, because Japan Food Atchison's ramen brand, right, is a franchise brand. They don't own the brand. They franchise it from the Japanese operator. So if ever the Japanese operator were to cancel the franchise, it will be a very great impact to their revenue and profitability, because this Ajisen Ramen actually accounts 61% of their total revenue. But when I go track back their shareholding, right, the person that franchised the person that passed the franchise to Japan Food, which is the owner of Ajisen Ramen, is actually also a part owner in Japan Food Holding. So unlikely that the franchise agreement will be terminated. So let's move on to the next slide. And we're going to talk about the management quadrant. So the Japan Foods founder is actually this guy called Takashi Kenichi. And there's another director on board, it's called Eugene Wong from Cyrus Venture Capital, which is also sitting on the board. And to me, the Japanese are known to be very honest and conservative, which we like. Okay, I like management who are very conservative. And when I talk to the management, I found out that he have a very strong Japanese accent. So when I talk to him, I having hard time understanding what he's trying to say. And when we first started out, right, we never really focused a lot of attention on the management when we invest in this company. But in my opinion, this management is not a tip-top management. But the management got one good thing. They are very good at cutting costs and keeping the costs very low, which is what I like. So the internal policy is to always reserve cash and for at least 6 months of the operating expense to tide through any thunderstorm. That was the management policy when they said. So this is the conservativeness that I like about the management. And the next thing is the management would never sacrifice bottom line result for the sake of higher revenue. As such, they are not adopting any aggressive growth strategy in Singapore due to high operating expense and also mainly the rents and the labor expenses. So, like I mentioned, the management is very conservative, and this is what I like. Conservative investors should like the kind of behavior that Japan Food founder is managing. Okay, and I personally like such behavior. So when we look at the shareholding ownership of the share, you can see that the chances are very high that the management, Takashi, right, will work hard and will drive earning for the future because he owns 77.45% stake in Japan Food. It reflects an alignment with us as shareholder. And you can see that Cyrus Venture, which is owned by Eugene, he owns 4.52%. And the Shingemitsu Kazuki, which is 2.12%, is the owner of Ajisen Ramen brand in Japan. Next is, among these managers that is managing the Japan Food, the highest paid person is actually Takashi, okay, the chairman and CEO. Okay, since he managed and oversee the company's profitability. So on top of his salary, you can see that half of his pay is solely based on profit-based sharing. So in other words, he will get higher pay when the company is doing well and vice versa. So that is very good for us as an investor. The next thing that caught our eye when we invest in Japan Food was that Eugene, the Cyrus Venture Capital guy, which also owns Japan Food, he is acquiring Japan Food shares ever since IPO. So when the company IPO, their valuation was not very expensive, which is why I can see Eugene is acquiring more shares in the company moving forward. So that gives us a very positive sign of this company. Next is when we look at the financials, you can see that their revenues are continually growing, which is a good sign. Their net profits is also growing. So please note that the drop in 2009 was due to the higher rental rate and the utility charge. And also the initial startup cost of 2 of their new outlets and fixed assets were written off due to the relocation and closing of their outlets due to landlord decision to revamp the mall. So all these are one-off expense. So which is why you can see after in 2010 their profits went up higher. Next, let us talk about their margins. So if you look at their margins have been rather stable, okay, and very consistent due to their in-house production of noodles and the management good cost control and reduction in food waste. So this one thing I like about the management. So let us look at the debt. You can see that the debt level is rather low debt level, which I like conservative management. Their current ratio is very healthy, pass our criteria. They have rather high return on equity. Our target is 15% and it's more than 15%. They have 29 and 34% in 2009 and 2010, which what we like. They generate very good return on equity. So now I'm going to explain my concern about Japan food before I bought into them. Firstly, the business model is not exactly outstanding. It's just a decent business model. I'll say it's a fair business. Okay, not very outstanding and not very bad. Secondly, the company is operating in a very competitive environment and there's no obvious economic mode. So the only advantage is that the management is conservative and is good at cutting costs. And lastly, they recently IPO in 2009 and does not have much established track record. However, this company is trading at a very cheap valuation, which makes me considering them. So let us look at the share price of Japan Food when I look at them. So because the company was trading at the net cash position with a 4 times PE when I bought in them, it definitely looks attractive to me because my downside is very limited. Which brings me to the point I mentioned in video 2 that if you buy into a company with enough margin of safety, even if the company is a fair or lousy business model, you still can turn out to be profitable. So in the end, this company actually continued to perform well due to the management conservative nature and cost-cutting measure. Its share price actually shot up in tandem with the growth in their earnings. When the share price was around 80 cents before the second bonus issue that the company issued out, I felt that the company growth have been limited and the valuation is not cheap anymore, which is at 17 times PE ratio. Compared to the time where I bought is at 4 times PE ratio. So I decided to take profit and sold my stake at an average price of 80 cents, which I've made about 175.92% gains inclusive of dividend in just 3 years. Can you see that how I use the investment quadrant to analyze the company in a systematically way, and once it fulfills all our quadrant criteria, we will buy into it just like Japan Food. So it fulfills everything and we bought into it. So since now you have a clear understanding on how we use the quadrant to analyze the company, let's move on to the next case study. The next case study I'm going to share is this company called Major Cineplex, a cinema operator which is listed in the Thailand Stock Exchange. So we bought this company in June 2014 for 18 baht and recently we sold in March 2017 for 35 baht. And we make about 102.14% inclusive of dividend in just 3 years. So let me move on to analyze using the investment quadrant and show you how did we analyze this company at that point of time. So now let us look at the business of Major Cineplex. So Major Cineplex is a leading lifestyle entertainment company in Thailand. They have about 6 business segments that complement each other. They are cinema, bowling, ice skating and karaoke, advertising, rental and services, movie content and even strategic investment. Now I will go more in detail in each of these segments. So Major operates in Thailand. They earn their revenue from admission, which is the ticketing, and concession, which is selling of popcorns and drinks. And they own cinema brands like Major Cineplex, EGV, Paragon Cineplex, Esplanade Cineplex, Paradise Cineplex, Mega Cineplex, and Hyatt Cineplex. So at the point of time, they have about 68 branches all over Thailand with 479 screens, which equals to 114,750 seats. Within their cinema compound, right, they also operate bowling, karaoke, and ice skating business. So under the brand, right, they have Major Bowl, Blue O Rhythm and Bowl, and Sub-Zero Ice Skate Club. So out of their 68 branches in Major Cineplex, they have 24 of them have bowling, karaoke, ice skating business within the compound. So in total, they have about 397 bowling lane, 256 karaoke room, and 5 skating ring at that point of time when we look at them. Next is their advertising. Advertising is one of their major, most lucrative business segment. Annually, they have about 25 to 30 million customers visiting their cinema. So the advertising leverage on major cineplex existing cinema infrastructure that they have already built. So selling advertising space on their movie screen, when you look at the movie, while waiting for your movie, there's a lot of advertisement, so they sell that space. And also the building, some of the buildings have signboards, so they sell that for advertising space. Next is their rental and services. So major cineplex started off building what they call stand-alone cineplex building, which the whole building they own by them, which consists of shops, cinema, entertainment like bowling and karaoke. So major owns this stand-alone building and they rent out this retail space and collect rental. So at that point of time, they have about 16 locations which have 50,403 square meter of space, and their occupancy rate at that point of time was 88%. And they also own this company called M Picture, which consists of 3 business segments. Firstly, they have this upstream theatrical distribution service, which they manage 52 weeks film programming, and it also helps to smoothen out their revenue due to the season imposed by the Hollywood's films in the second quarter and holiday season films which release in fourth quarter. Secondly, their downstream business where they manage the timing of release of the DVD. So every time when the movie was released, all the way to once the movie ends, then how many weeks later they're going to release the DVD and VCD. So this segment manage that part. And lastly, the film production business, which they run this company called M39. So M39 helps to produce and grow Thai film in Thailand. Major Cineplex did a few strategic investments to grow and complement their business. So for instance, Siam Future, which they own 23.72% at that time. So this company actually developed low-rise open-air building next to the residential area in Thailand. The rationale for Major Cineplex to invest in Siam Future is to help each other to grow their business. While Siam Future develop more buildings, Major Cineplex will place their cinema in every of the buildings that Siam Future built. So because when you put cinema into the mall, it will attract more traffic into the mall, which in return gives Siam Future better rental rates, which also benefits Major since it owns Siam Future. Next is Major Cineplex actually lists their Major Cineplex Lifestyle Leasehold Property Fund, right, in the stock exchange. So it's like a REITs. It's a REITs that is spin out of Major Cineplex. And the total capital raise was about 2.3 billion baht in cash. So Major Cineplex is able to take the money that they raise, reinvest part of the proceeds back into Major Cineplex Lifestyle Holding, which is MLJF, which now they own 33%, and the remaining fund is used to build new standalone Cineplex building that they own. So with this structure in place, right, Major is able to grow the standalone Cineplex building without using any fresh capital. Because once they build the new building, they will inject the new building back into the REITs, and the capital is unlocked and recycled to take the money again and go build another new building. Next is Major Cineplex also owns 50% in K Arena, which is a karaoke business that complement their karaoke business segment. They also own 40% in Thai Major, which helps to make major ticketing sales channel more efficient, such as consumers are now able to purchase concert ticket, sports ticket, events tickets, and transportation ticket at major box office, which generate more traffic into Major Cineplex, which could also entice consumers to consume other entertainment service provided by Major. So Major also invests 6.41% in PVR, which is India's largest cinema operator, to help them to grow. So now let us look at the sales segment of Major Cineplex. So you look at their cinema segment have been growing. Their advertising segment also have been growing. Their bowling, karaoke, and ice skating is rather consistent. Their rental have been rather consistent. Their film distribution is the only one that is dropping greatly. Okay, so take note of all this. So if you look at the past few years at that point of time, I see in 2013, the revenue have been growing at the 8.6% growth per annum. So let us look at their revenue contribution. So cinema is the largest contributor, which is 68% of their total revenue, followed by the advertising, which is 14%, and the rest is equally split at 6%. So next is we're going to talk about the economy mode of major cineplex. So major cineplex, one of the economic mode is their economic of scale, which they have 80% market share in Thailand's cinema industry. SF is the second largest cinema behind them, and major already owns 80% of the whole Thailand. Next is this company is actually recession proof. Okay, so during 08-09 crisis and even Thailand political crisis in 2013, 2014, the company is still growing in revenues. So let us look at the growth of the company. So major cineplex have decided to continue to add 30 to 40 new screens every year for their expansion. So they plan to, increase the screen they plan to increase the screen to 1,000 screen by 2020, year 2020. Not only that, out of the 77 provinces in Thailand, major are in 33 of them. So they are currently in Bangkok, and the upcountry's percentage is around 50-50 percentage. And major intend to grow the upcountry, which is their rural side, to make sure that it's more than the Bangkok by 2015. And this is the founder of Major Cineplex, Vicha Pomvalak. Let me show you the ownership stakes that he owns. He owns about 34.49% in Major Cineplex. And he is one of the best capital allocator in Asia I ever seen. Okay, he makes strategic investment into Siam Future, Major Leasehold Property Fund, MPIC, and PVRL. At the point of time, right, it makes positive gains for all the investment that he made. You can see that all the gains are all positive. So, and he also able to work with Siam Future to grow the business together. And he also, like I said, spin off the Major Leasehold Property Fund as the first cinema REIT in the region, so that he does not need to always raise fresh capital to build more of their standalone major cineplex building. And also the next thing is he used debt, right, to finance the expansion of his business, major cinema business. So whatever cash generated from the cinema business are all returned back to shareholder. So this guy is very, very good capital allocator. So let us look at the financial. They have been growing in revenue. Net profit have been growing. They have rather consistent, stable gross profit and net profit margin. Their ROE is above 15%, which is past our criteria. Their dividend per share have been increasing, which is a very good sign for us as an investor. Okay, so hence at this point of time, Major Cineplex actually passed all our first three criteria, which is the business, the management, the financial, and only left with the valuation method. So now we are at the valuation segment of Major Cineplex. So this company, right, we bought into them in June 2014 for 18 baht and sold recently in March 2017 for 35 baht. The share price was depressed due to the Thailand political unrest in 2013 and 2014. So when the share price decreased, right, I made a personal trip to Thailand to check out the situation. When I was there, I visited some of their cinema outlet in Bangkok during the afternoon. And I realized that it was so crowded even in the afternoon. So basically, I conclude that the situation is temporary and people do not care about it and they still visit their cinema. So when we value Major Cineplex, we use another valuation ratio to value this company. And due to the political unrest, it becomes reasonably cheap. And so we bought into this company at 5.6% dividend yield, and plus, this company is still growing with a growth plan. So when we sold earlier this year in March 2017 was due to the valuation become re-rated and they are trading at a higher multiple, which we decided to exit from the business. Okay, 5.6% dividend yield. So that's how we put everything together and bought into Major Cineplex. When you have so many pieces of data pointing at the right direction, it's literally a no-brainer. And within 3 years, we double our investment returns from this company, bringing home a return of investment of 102.14% inclusive of dividend. Pretty awesome, right? Don't you think so? So if you enjoy the training over the past 3 days, I would just say that we're going to go even more in depth in the investment quadrant. So the investment quadrant is one of our flagship courses where we show you exactly how to fish for the right stocks to invest in. This is the formula that's responsible for many of our mega winners stocks like Centurion, which nets us 241.2% in 1 year, Supergroup that net us 243% in 2 years, New Group which net us 80.7% in 7 months, BreadTalk we make about 182.7% in 5 years and we are still holding the company. Cross Harbor, which makes 76.7% in 3 years, we just recently sold it in March 2017 also. And even Baostake Singapore, 119.7% in 5 years. So imagine you're able to double or triple your investment returns with the investment quadrant formula. Will that be helpful? The good news is for the next 3 weeks, we will be opening up the investment quadrant training course and accepting new students. Yup, we will pull back the curtain and bring you behind the scene to show you exactly how to fish for high ROI stocks with super low risk. So keep your eyes peeled on your email tomorrow for detail. This is Victor Cheng and I'll see you soon in the Investment Quadrant 2.0. Bye.